Assalamu alaikum, everyone. Good afternoon. Thank you for making the time. It will be myself, Talal Ragaban. I look after valuation and advisory in Knight Frank, joined by my colleague.
Assalamu alaikum. My name is Shazad. I look after strategy and consulting for Knight Frank, especially focusing on the healthcare and education space.
We've got a topic that we believe it is interesting at least. We're going to be discussing defensive assets or specialized assets from a valuation perspective and methodology.
The agenda that we're going to be covering is as follows. First is, why are these assets getting traction? The real estate investment type and the valuation approaches, and then we'll be delving down into valuation of special assets. We're going to be discussing challenges, the approach, risk and implications, what needs to be considered, and how do we actually value these assets. So for the first part of the agenda, we're going to be talking about the reason why these assets are getting traction, and what I can safely say for both healthcare and education, we feel and we find that this is the single most expensive capex that an entity incurs when investing in a school or in a hospital. Just to give you some idea of the type of investments that are taking place within the sector in Saudi Arabia in specific. So over the next 7 years, we're talking about $6 billion worth of investment in the sector and more than 50 plus projects. When I talk about education projects, we're talking about all the way from nurseries to schools to higher education, like universities, etc. If you look at the split of what's going on in the education space, close to 5 billion is being invested in Riyadh, about 432 million in Jeddah, and the rest of the nation follows. But you can see that the majority of the traction is in the major cities of the country. So if you're looking at the future of how this sector is going to perform and what is the requirement for this sector, we understand that by 2035, we would need close to 110 to 142 new schools in the kingdom, about 32 to 42 schools in Riyadh itself, and about 20 to 30 schools in Jeddah itself. So this is just talking about the K-12 sector. When we're talking about the opportunities within the sector, where is this? So the market segments where we find that there is great demand and great potential to scale is the K-12 and the early years centers. The SEN sector has been picked up by the government, and we can see that there's a PPP going on for five schools within the SEN space in the kingdom. In terms of price segment, we see that the most sustainable segment is the upper mid-tier of the education space. This is where the maximum demand can be seen. And in terms of curricula, I mean, the majority of the population, the local population, does like the Ministry of Education system along with the American system. But what we can see is that the IB and the British curriculum is actually catching up, and we can see newer schools come through in this space, which means that there is a lot of investment, and we would need to look at valuing such assets going forward. Maybe can I come on this side? Sorry. So if you're looking at the healthcare space, on the other hand, we see that the investment in the next 4 years is about $16 billion. More capital intensive. There's a lot more investment that is coming into play. And this is private sector investment. Riyadh, close to $7 billion. The rest of the country, about $7 billion, half. And Jeddah is about $2 billion. This is where the real demand is, and we can see that there's a shortage of bed supply within the sector. Plus, the sector is going through a lot of reform with the government trying to play a more regulatory role, and the private sector is being encouraged to invest in the sector and take this forward. If we look at the bed supply and the bed gap for the kingdom, By 2035, we'll see that the kingdom will be short of about 44,000 beds. That's, I mean, if we take into account the growth, for example, from 63,000 beds to 76,000 beds based on what is currently in process, in supply right now, or to be invested in committed capital versus what we would need further. Riyadh needs another further 8,000 beds and Jeddah about 6,000 beds. The opportunities are in certain specialities that we can see. Long-term care and rehabilitation is a sector that it has been slightly neglected. Maternity and pediatric, oncology and intensive care. Positioning has to be in the affordable segment and also certain premium segments of the society as well. But the product does not have to be big as 300 beds, it has to be a bit smaller so that there is a level of exclusiveness. Now, why I'm saying all of this? If you look at the demand drivers, we can see that on the right-hand side, number one, the population is aging. We have historically been told the population of Saudi Arabia is really young. But in the next 10 years, you will see that the population over the age of 60 increasing by 3 times. That's a significant jump, and we will need to start taking care of that population. Then, of course, there is insurance that has come into play, where a lot of now, about 22 million people will be insured from the Saudi population as well, which will help boost the private sector, because a lot of them would not want to go to the public sector and would be looking to look at the private sector for care. Then, of course, there's more urbanization, and there's a lot of PPP projects going on in the major cities, so there is a drive for people to actually relocate to Riyadh, and we can see that. And Jeddah as well, and going forward, we'll see these people move to Neom and Red Sea and all those giga projects as well. So that's how all of this is happening. And of course, non-communicable diseases. Because of lifestyle choices, there's a high incidence of non-communicable diseases which needs to be addressed. So now that I've given you a bit of theory and why the sector is important and why we need to start looking at the real estate in this asset class, I'll ask Talal to talk some numbers and yields.
Right, so you're leaving me with the tricky bit. Those assets typically don't trade based on their costs. That's the starting point that we will get into later on in the presentation. But today, there are very few transactions that have happened in the market in those defensive assets by definition. Those assets tend to be held on a very long-term lease, a head lease. So you haven't got any OPEX for you to worry about as a landlord. You haven't got multi-tenanted property to look after in terms of collection of rents and so on. All what you need to do is collect a single check, but ensure that check comes in. And for that reason, you'd see that there is a big variance in the yield curve. You'd see some of them trading at almost 11%, while others have traded just at the 7.5%. And that's a very big gap in between. And that all comes down to the covenant strength. Who's your occupier of the building? Who's your tenant? How reputable they are? How good they are at what they do? And at the same time, how solid are their financials? Because if their business go bust, your property would not have the head lease anymore. Your property is only as good as the business that occupies it. And this is why you've got such a significant yield variance between those transactions.
I mean, while Talal does say that there is a variance and a lot of that can be explained, but we can still see that it's still, majority of the transactions still fall in a certain tight range, which we could expect from such an asset class, and could be at a premium to the other asset classes which are more conventional, if that's how you want to look at it. So historically, when we talk about real estate valuations, he's putting me on the spot here because this is not my area, but nonetheless, I'll give it a go. For bank debt, for year-end financials, for business combinations under the IFRS 3 mandate that you would require, insurance, sale and leaseback transactions, and IPOs. This is what historically we would be looking at real estate valuations for.
And now once we know why we want to do it, we really need to look into how we do it. Let's start by saying, historically, a lot of people used to value assets on cost. Perhaps 5-10 years ago, that was an acceptable methodology, but the profession has evolved, the standards have evolved, And today, you can only look at the cost approach. If the property is not capable of producing income, or the property is very specialized in use that it has no direct comparables. So if you're talking about a museum, fine, value it on cost. If you're talking about a heritage building, that's another appropriate methodology. Once that the building has comparables in place or the building is capable of producing income, you're going to have to look at other valuation methodologies. You're going to have to look at the comparable approach, which is basically trying to find the most comparable property to your subject property and doing the benchmarking and the adjustments accordingly. And that goes back to the theory of saying no two properties are identical. So each property will be different, and that means adjustments needs to be made. Moving into the income approach, and the income approach has too many different methods below it. So you've got the profits method, you've got the discounted cash flow, which is the conventional method, and then you've also got the method that we will tap into in a bit, which is a rent relief method, which is a combination of both your profits and DCF methodology. And that's the most applicable in our case of valuation. The last bit before we move on is the residual approach. And the residual approach basically looks at whatever you are capable to produce out of the building, assuming it is completed, deducting from it all the costs that would take you to develop that building, accounting for all the risks that you need to take into account in your cash flow.
So now we'll get into the special assets.
So back to this point again, the special assets, they're not directly comparable. You wouldn't have a school and be able to compare it to another school in the market. So that takes out your comparable approach out of the equation. They don't transact frequently, which is something we've seen with all the published transactions. There is a handful or two handsful of transactions that you can see in the market. They provide a steady and stable income stream, meaning that once you've signed your lease, you're good to go for a very long term on those properties. Leases would typically be 15 years plus. You'd rarely see any new lease being signed on less than 15 years. And generally, the investment risk is lower, but there are other risks that we're going to look at as we go on in the presentation.
The challenges in valuing such an asset, a lot of the unique attributes actually turn into challenges when we're looking at such an asset. For example, like Talal said, that there is no one facility that is actually unique. If you're valuing an apartment or an office building, at least there is some comparison that you can do. The next door apartment went for $100. This one will go for about $100 plus minus condition. But in the school, it all depends on what type of school. In a hospital, it also depends on what type of facility, how is the operator, what's his performance. And like Talal mentioned, lack of comparability. Then another factor that actually fits in is the regulatory requirements for running such a facility, right? Because regulatory requirements have evolved, which has resulted in about 42 schools shutting down in Jeddah alone in 3 years' time back in 2018, right? So these are factors that we would need to consider when we're looking at evaluation of such an asset. And then, of course, like Talal also mentioned, the occupier performance, and again, there is a single tenant. That means if there is any vacancy or you think you can just boot the person out, that means that you will have zero income for that time frame. But again, once all you need is one tenant and everything is secured. So when we're looking at the approach, basically what we are trying to say is that it is a variant of the discounted cash flow methodology, whereby we look at we've termed it as the affordable rent method or relief from royalty method. Relief from rent method. It's the value that represents rent savings that the asset can generate on a present value basis if rented on an arm's length transaction. That's effectively what it is. But whilst we are considering the rent that the asset can pay, we should ensure that it's not unnecessarily straining the financial resources of the operations of the entity. We have seen in the past that people want to say that, my asset can generate X amount of rent and I will be able to afford to pay that. But what happens is it strains the resources of the institution and we see that securities have been placed or called into play, the facility has shut down because of these reasons. So the thing is that we should not be overly greedy when we're looking at such a methodology, and should remain within the confines of the methodology when we are doing the valuation, and also when we are seeking a valuation if you're trying to do a sale and leaseback transaction.
My favorite topic, risks. So you've got risks that are related to the property, but then you've got the other types that are related to the tenant itself. If we look at the property as a starting point, your most challenging part is your zoning. Once it's a school or a hospital, it's going to remain as a school or a hospital 99% of the cases. For you to change your zoning, it's going to be a very hard and lengthy deal to do. So if you're going to stick with the same zoning, and then you're going to have to look at the physical location of the property itself today, and you're going to have to measure it against your demographics, because at the end of the day, because you cannot separate the property from the business, your business will only do as good as your demographics allow it within the catchment area. And then if you look at the shift in the local market landscape changes, suddenly when you're looking at the growth of the city and how the city is evolving, 5 years ago it would have been a very nice area for a school to be located in. But then given how rapid is the growth that's happening today in Saudi, and how the demographics in each district or neighborhood are changing, this imposes a very significant risk that we must be thinking of all the time. Then the other bits are the tenant-related risks. And if we were to sum it up at the end of the day, it's how confident you are from getting paid that single check every year. And what are the reasons behind it, or what are the key details behind it? You're going to look at their financials. How good is their business model? How good is their business plan? How good is their management team? What's good, the curriculum that they are delivering? And then the demand that will be there continuously for this product. And then in the terms of the implications of those risks, a lot of times, especially when it's a sell and a leaseback transaction, a bit of reverse engineering might happen when people are trying to make a deal and set a rent that will give them a certain value. And the risk of doing such is great, because it might do the trick for a year or two, but down the line, the business might not be capable to operate sufficiently and be able to pay the rent that it's supposed to pay. So always having a property that's overvalued due to the fact that there is a bit of rent that is excessive from what the operator can afford is a big risk. But in the same time, undervaluing an asset is equally as bad. You'd always want to ensure that the asset value is reflective of the market conditions and be in the right place instead of overvaluing or undervaluing the asset. The next two bits, which are very related to each other, I'll hand it over to Shazad.
Sure. So when we look at it, now imagine that you're carrying the asset in your book, right? And there's an operator who's leased the school from you, let's just say. Due to any reasons, you've decided that, you know what, I am going to push the value or get a higher value on my book, and I'm going to record it. Short term, great. Yes, there is an unrealized gain in your financial statements if you're using that as a methodology. But now the thing is, when the time comes to exit, how will you exit? Because you've got some asset that is actually overpriced sitting in your book, and you're not able to exit at that price because the market does not see it so. Similarly, if you have undervalued the asset, whilst the market is seeing that probably there is more potential in the asset. But the thing is that there are lots of people who actually don't look at it that way. They think that there is an issue with the asset, which is why you have actually undervalued the asset. So it's always advisable to just ensure that you arrive at the value, which is the market value, and that's what you should recognize. Otherwise, in the short run, you may get away with your objective, but in the long run, this comes and bites you. So how do we actually undertake the valuation? Would you believe it? We've got 2 medical doctors on our team. We've got a headmaster on our team, and a chartered accountant as well. Actually, 2 chartered accountants on our team, right? Excluding myself. And then we work with our real estate team to actually see how to look at the value. So I'll just give you an example. So when we're looking at it from an education or a healthcare perspective, we get that particular expert on board. Now imagine if a finance professional is trying to do a study on the market versus a healthcare professional who understands the healthcare sector, who understands what services are being provided, actually does the market understanding. So they understand the market, they understand the landscape, they understand the micro and micro implications, they understand how your services are actually performing versus the market, they understand whether your services within this market will actually be required or not. They look at it from the entire holistic perspective from a very specialist angle. They then pass this information on to the financial expert who has at that time been looking at the financial performance of the school or of the hospital. They've analyzed and removed all the non-recurring items and all these sort of things, and then have also started analyzing the business plans, which are then fed and actually given a lot of color by our healthcare expert. And that's when they arrive at the forecasted or theoretical rent, or forecasted income statement for the facility, and then they derive out the theoretical rent. And that is when the real estate valuation guys come in. When they have looked at it from the site from a real estate perspective, they've seen whether the regulations are being met and followed, and that's when they put a cap rate on and discount rate on the theoretical rent to arrive at the value. So this is the entire structure that is followed within our organization in order to provide you with a market value for the facility, rather than just giving you a depreciated replacement cost and asking you to live with this, because that's not reflective. And to give this more color, because I'm sure for those of you who've been listening to us will be saying, okay, so how much of the rent, how much of the EBITDA can be allocated towards the rent, right? How are you going to arrive at the yield? So to answer that, what we believe is that the rent actually cascades between a fourth of the EBITDA to a third of the EBITDA. A third of the EBITDA to a fourth of the EBITDA, right? And that's primarily because as a operator, you wouldn't want to give up more than a third of your income towards the real estate operator. This methodology has come through based on a lot of court cases that have gone through in the West, as well as taking inferences from valuing brands, where if you have an asset that you provided somebody and the person is making use of that asset, you wouldn't pass all the synergies of that asset to the landowner. You would be having all the synergies to yourself. So basically, based on the condition of the asset, based on the quality of the asset and time frame, we cascade between a third and a fourth. And in terms of the yield also, what we do is that based on the quality of the investment, the quality of the returns, is how we dictate where the yield actually sits. So it's a combination of what percentage of the EBITDA and also the yield that is allocated. So when we're looking at it from an operational perspective, we look at the business on the stage of the life cycle, the enrollment and occupancy on a school perspective, or let's just say the occupancy levels in the hospital, the financial performance, and for a school, for example, have there been proper placements in better colleges or not, is what we're seeing from the quality perspective. From the location perspective, does the school fee fit the catchment area? What's the level of competition, and are there new schools entering the area? That would have an impact on the sort of income that we can generate going forward. The physical aspect from the real estate perspective is the asset well maintained? Are there any structural faults? Is there maintenance and insurance contracts in place? And then, of course, from a financial perspective, we need to look at non-recurring items on the income statement, because that can actually have an impact on the future, on the forecasting, and also staff retention from academic perspective. Tenant terms is what Talat had mentioned, but effectively this is how we look at the asset and then advise on what the value should be. Thank you.
Thank you, everyone. Would be pleased to take few questions, if there are any. Right, we've been very clear. That's good. Thank you very much for making the time.
Thank you very much. Thank you.